Hey guys, Jordan here with Cashflow AI, and in this video, we're going to talk about systematic versus unsystematic risk, the most important piece of risk management for options traders. Whether you're trading algos, whether you're manually trading, it does not matter. This is essential to being a profitable trader. So let's dive in. Now, there's two types of risk in every trade. There's something called systematic risk, which is called market risk, or unsystematic risk. Now, systematic risk means it's risk that affects the entire market. So you cannot really diversify from that specifically. Now, there's also something called unsystematic risk, which is risk specific to one company or sector. Now, this can be diversified away. Now, this is a very important difference that can literally save your entire portfolio. So systematic risk is something you can't avoid. So example, if the interest rate changes, if there's a recession or an economic downturn, if there's wars or events, if there's like a pandemic, right, or a huge market-wide crash, you can't really avoid that, right? No matter what kind of stocks you're holding throughout these things, they are going to be affected. Now, unsystematic risk is something that you can fix, right? So let's say a specific company, they have poor earnings report, or the CEO scandal, or they resign, right? There's a lawsuit with the company. Things like those, you can be diversified from that because they're tied to one specific company or industry, right? Now, this is important because systematic risk is not diversifiable, and it's measured differently, right? This one is measured by beta, which I'll cover in a second. Unsystematic risk is defined by standard deviation, and there's a lot of good solutions to each of them, right? You can either hedge or just accept the loss, or unsystematic, you can diversify. So here's a real example, right? Let's say we have the COVID crash. We all know March 2020 is when it started. The S&P dumped 34% a month, right? Now, this is something you can't avoid if you're holding long-term stocks, right? Amazon was down, Microsoft, Zoom, right? Almost all these stocks, they all crashed together when this happened, right? So that's systematic risk. Nothing that diversification is not going to help you there. Now, and another example, Boeing, when Boeing in 2019 had a crazy, a lot of issues going on. A few, planes were kind of getting grounded. A lot of weird things going on. Boeing was down, but the S&P was still up, right? Competitors were still up. And so that's having unsystematic risk, okay? Only Boeing was affected. So if you were diversified, it would have protected you. Now, beta measures how much a stock moves relative to the market. And this is very important for understanding systematic risk, right? For example, S&P is always going to be 1, right? Because that's what the market is. Apple is going to be slightly higher because it's slightly more volatile, right? Utilities are going to be way less because they're less as volatile. Something like Tesla is extremely connected to the market, right? So the market drops 10%, Tesla is likely to drop 20%, right? And so that's understanding beta. So you know that if you have a portfolio with a very high beta, well, if the market crashes, a lot of your stocks are going to crash as well. Now, this is a bad example because, if you want to put all your eggs in one basket, you can do so having high beta stocks. So let's say you have 50 naked puts on Tesla. Well, again, with systematic risk, if the market crashes, which again is out of your control, and Tesla is going to drop like 24%, you're going to have a huge loss by selling those naked puts. Same thing if you were just holding shares. Unsystematic risk, well, let's say Elon tweets something controversial. There's an earnings miss, right? The stock crashes. You can still have a massive loss, but that's due to a different reason. Nonetheless, you are still exposed to crazy risks, right? This is not good risk management. A better portfolio would be one that's diversified, right? We all know this, right? If you have 20 different stocks across different sectors, finance, energy, healthcare, whatever, now your unsystematic risk is eliminated, right? Because if Tesla crashes, it's only a small percent of your portfolio. The systematic risk is still there, right? Because if the whole market crashes, it's going to affect all the different 20 stocks you have in your portfolio. So how many positions should you have to diversify? Well, unsystematic risk can be defined by a percentage of how many stocks you have. So let's say you have 5 stocks in your portfolio. Well, you're about around a 40% unsystematic risk remaining, right? And obviously, the more stocks that you have when you have 50, you're going to have a less chance of that risk. Now, sweet spot is typically 20, 30 positions. This is not financial advice, but typically what we find when you're trying to diversify across specific strategies or stocks. Now, hedging systematic risk is something that you must do because you can't diversify away from it, right? If the market crashes, and you're holding a bunch of stocks, you're just going to see your portfolio dwindle down. So you must hedge, and you can do this in a few different areas. You can buy VIX calls, right? Profit from volatility spikes. You can buy SPY or QQQ puts. You can reduce your size, so the market starts to crash, you basically just cut most of your positions. Or you can do collars, which are basically insurance on the index, another type of option strategy you can set up. And hedging will cost you money, right? If you buy puts and the market keeps going up, well, you're going to lose money on those puts. But it does save your account during different crashes. Now, there is something known as a correlation problem, which you also really need to understand, right? So in normal markets, let's say the correlation is 0.3 to 0.6, stocks tend to move independently, right? So the market's just kind of going up, like we saw a lot of 2024, most of the second half of 2025 as well. Diversification works. Now, if the correlation goes up when the market crashes, which is what typically happens, well, all stocks tend to crash together. So it doesn't matter, like, if the market crashes because of COVID and you're holding a stock like Zoom, which typically would benefit during a COVID crash, it doesn't matter, right? Correlation goes up and diversification kind of fails. And this is why you must hedge systematic risk separately, okay? Another case study, so if we look at the Q4 2018 correction, the S&P dropped 19% in 3 months. Now, if you're trader A, you have no hedge, and you're still diversified, you have 30 diversified credit spreads, but no hedging, well, you're going to lose 24%. Now, if you're hedged, you're in the same 30 spreads, but now you just take a 5% of your portfolio and put it into SPY puts, well, this trade only lost 8%. And that's a huge difference, resulting in a 24% drawdown versus an 8% drawdown. And that's why hedging is the difference between survival and seeing a massive loss. So is hedging actually worth the cost? Well, again, without hedging, you're going to see a little bit higher on your bull years, right? You can see 25% versus with hedging, you're going to only see 23%. But on the bear years, when the market crashes, you can be down 40% and blow up your account versus if you're hedging, you're only going to be down 10% and you're able to survive and continue. So yes, you can think of hedging like insurance. You're going to pay a small percentage in your winners to avoid your massive losses. In my opinion, I believe it's totally worth it. Now, another dynamic hedging strategy is you can look at the VIX, right? So the VIX is a volatility index, kind of helps you determine what the market is doing. So if it's under 15, market is complacent, right? You're able to basically increase hedging. If it's normal, you want to have moderate hedging. If it's above 25, that's when a lot of fear starts to kick in, and then you can kind of reduce your size. And if VIX gets ever above 40, which it does a few times, that's in a state of panic. The market tends to be over dramatic. You kind of see those big crashes, the big moves to the downside. That's when you typically want to sit in cash or hedge a little bit more. Okay, so it's really important to hedge based on different market conditions. Now, position sizing is also the first line of defense, right? Now, because if you're going in with 30% of your position, well, hedging doesn't really matter. You're still going to lose a lot if there's a big downside. So conservative recommendations, typically about 3 to 5% of your portfolio per position, okay? You're able to keep a lot in cash because not only is that going to prevent you from having these big drawdowns, but it's also going to allow you to deploy that capital when you see new opportunities or new stocks or strategies that you want to get into. And it's going to help you survive black swan events. If you're aggressive, which is dangerous, you can see 20 to 30% per position or per strategy, and you can be very oversized and blow up your account. Now, again, you can apply this to specific strategies or trading bots or portfolios themselves, right? So instead of 3 to 5 per position, it could be 3 to 5% per trading bot or per trading strategy, right? And then you also want to keep some cash as well. Same thing with trading algorithms or building a portfolio of trading algos. You want to be able to do the same and be conservative with your position sizing. Let's have an example on iron condors on SPY, a very popular trading bot that a lot of users use. The systematic risk is very high because if there's a big market move, you're going to lose. If the VIX spikes, it's going to be hard to exit. If there's any Fed announcements, things like that, you're basically just trading the market. If you have unsystematic risk, okay, well, SPY is technically 500 companies. You're already diversified, right? And so those individual stocks won't matter. So you're able to get iron condors on a bunch of different companies as opposed to just SPY. You kind of get a little bit of that edge. So 10 risk management rules, takeaway from this video: never risk more than 3 to 5% per trade. Again, if we're talking about per strategies or per portfolios, you can do the exact same. You want to diversify across multiple different positions, whether that's different strategies, different bots. You want to know your portfolio beta, okay? If it's above 1.2, typically it's good to hedge. You want to hedge when VIX is less than 15. Okay, hedge when it's in favor to do so. Max 25% per sector. Watch your correlations. Okay, reduce it if it's greater than 0.7. Keep a decent amount of cash always on hand to reduce those drawdowns, but also hedge and give you opportunity to use that cash elsewhere. Use dynamic hedging. Always have an exit plan, and review weekly, adjust monthly. So I hope you guys did enjoy this video. Many more to come on this channel, and I'll see you all in the next video.